Good afternoon, everyone. Thank you for joining our webinar today, Unpacking Personal Tax Returns, a forensic approach to Form 1040 filings. My name is Samantha Brennan, and I'll be your moderator for today. This webinar is going to run for about an hour. If you have any questions, please drop them in the Q&A, and we'll address them as time allows. I'm just going to introduce our speakers, go through our disclaimer, and then we'll get started. Our first speaker is David Grelnick. He's a partner here at KLG, who's worked extensively with closely held companies, attorneys, accountants, and financial professionals on business valuation, investigative accounting, enhanced earning calculations, and damage claims. His background includes litigation, consulting, forensic accounting, auditing, and taxation. Joining him is Lou Panariello, also a partner here at KLG. Lou has extensive experience in forensic accounting, business valuation, litigation consulting, and damage claims. His expertise spans matrimonial matters, estate and gift tax planning, shareholder disputes, corporate planning, business transactions, and financial asset tracings. He's also been court appointed as a neutral financial expert and has testified as an expert witness. Just going to go through our disclaimer quickly. This presentation is for informational purposes only and does not provide legal, accounting, valuation, or tax advice. The views expressed do not necessarily reflect those of KLG Business Valuators and Forensic Accountants, LLC. Any examples provided are for illustrative purposes only, and the materials from this presentation may not be distributed without KLG's express consent. With that, let's get started. I'll turn it over to Dave and Lou.
All right, thanks for the intro, Sammy. All right. So the way that this program is going to work is we're going to go through the Form 1040. We're going to go through it sort of in order. There are going to be some parts that relate to our presentation last month, which was the business tax returns and how that information is reported on the personal tax return. So if you happen to have those slides available, you can follow along that way. But on our shared screen, we're gonna put them side by side for you. So don't worry if you don't have it. So let's start with page 1 of the Form 1040. So right at the top of the Form 1040, page 1, is some pretty high-level information, that may not seem so important, but could lead to a lot of oversights. So first and foremost, this tax return is for the year 2022. It's always important to know what year you're looking at. Second piece of information that's right at the top is the filing status. So you're going to want to know, who is this tax return reporting the income for? So in this case, it's married filing jointly. If the married filing separately box is checked off, you're going to want to get the other tax return for the other spouse. Okay. Moving down a little bit, you have your name and address, pretty typical information. Right below that is a disclosure for digital assets. So this was introduced by the IRS in 2020. That's the first tax return that you'll see this appear on. And what this is basically a disclaimer right up front, whether or not digital assets, so that's cryptocurrency, that's NFTs, it's not just limited to one type of digital asset, it's all digital assets, and whether or not any digital assets were received, or sold, exchanged, gifted, or disposed of in any other way. Key term that is not included in this disclaimer is whether or not any digital assets were purchased. So just keep in mind, if this box happens to be checked as a no, it doesn't mean that there were no digital assets that were purchased during the year, only received, sold, disposed of, etc. And in terms of receiving, you can receive, digital assets and cryptocurrency, in the form of compensation from a job, or maybe some sort of a reward for gambling, which Mr. Grownick likes to do from time to time, things of that nature.
In this case, you can see it was marked yes, so we'll be talking a little further about that later on.
That's exactly correct. Scrolling down a little bit, we have our first income item, which is Form W-2. So as you can see, there was $305,000 on this particular tax return of W-2 income. that was reported. Now that happens to be just one number. There could be multiple W-2s that go into that $305,000. So I'm just gonna shoot on down a few pages. And just to go back, if you notice, there's a reference here to statement one, STMT, that's an abbreviation for statement, and it's statement one. So attached to Form 1040 to the personal tax return are what are called federal statements. And you'll see these references throughout the tax returns, okay? And what that means is there was more information that couldn't be reported in this one single box here. So this taxpayer or the tax preparer attached a statement to this tax return to give you a little bit more information. So I'm going to go down to our federal statements in our tax return. So statement one, as we saw, $305,000. This happens to be one single W-2 in the amount of that full $305,000. Over on the left here, there is a T. So this could be denoted as a T or an S. T stands for taxpayer. S stands for spouse. Now, if we go back to page one, you'll note that the first person that is listed, your first name, that's the taxpayer, that's the T. And the second line, if joint return spouse's name, that would be the spouse. So if that was a W-2 for the second person listed, the spouse, you'll see an S next to that 305,000 instead of the T. Now, keep in mind, when you're thinking about income and cash flow, this is a tax return, and what's being reported is taxable income, okay? So just because you see $305,000 doesn't mean that that's the totality of the W-2 income. There are certain items that are deducted from your W-2 income, like 401k contributions, as an example. To the extent that those existed, those would not be reported in this first line here because they are not taxable.
Also, just to make a note from our previous one that we did on corporations, this 305,000 is the exact same amount as officers' comp on one of the tax returns we did last time.
Yep. So let me see if I can actually find that quickly for you guys. Where did that just go? Business tax return. Sorry about that. It popped up on the wrong screen. Okay, so this $305,000 number is actually included in the $709,500,000 number. If we scroll on down to this form that we discussed last time, Form 1125E, which is attached to the Form 1120S. Okay, this gives us a breakout of the compensation of officers. So that $305,000 that was reported on the business tax return is reported as W-2 income on the personal tax return of this particular officer. Okay, getting back to page one. Okay, so we have a couple of items here, lines 2A and lines 2 and 3 in their totality. We'll get into Schedule B a little bit more, but line 2 is for interest, any taxable interest. Line 3 is for dividends, okay? And we'll, like I said, Schedule B will have the detail to this, so we'll get into that in a little bit. I highlighted qualified dividends and ordinary dividends here. It's a question that we get a lot. Are they the same? Are they different, right? So qualified dividends are dividends that are issued by United States corporations, right? So if you have, Apple stock and they issue a dividend, it's going to be reported in the qualified dividends. The qualified dividends are part of the ordinary dividend. So when you look at this $14,000, you wouldn't add it to the $29,000. It's already included in there. The reason that the Form 1040 has a special place for these qualified dividends is because they are taxed at long-term capital gains rates. So what this is telling the tax return is when you're taxing these dividends, take $14,000 of them and tax them at a different tax rate, at the long-term capital gains tax rate. So we'll get into interest and dividend reporting on Schedule B in a little bit. The next line item that I want turn your attention to are capital gains and losses. So the detail to this is going to go over to Schedule D, which Dave is going to talk about in a little bit. So take note, this has a minus $3,000. So that's a loss of $3,000. Now, the tax rules, bless you, the tax rules only permit a $3,000 of capital losses to be deducted on the business tax return. So this number, the capital loss number, could be $500,000, right? But you're limited to $3,000. Now, what happens to the rest? There's going to be a carry forward, and you can use that capital loss in future years. Dave's going to show you exactly how to see that on the personal tax returns.
And let me just add something that you can take all of the capital losses as long as you have capital gains against them. But if you have no additional capital gains, you can only write off $3,000 of the capital losses in any given year. And from there, there'd be a carry forward into the other
Right.
years.
So losses in excess of the gains.
Correct.
The last three numbers that I highlighted down at the bottom are total income, adjusted gross income, or AGI, and lastly, taxable income. So the difference between the three numbers is related to the deductions that the IRS allows from each one. Okay, so from your total income, you could deduct student loan interest. There's the QBI deduction. Okay, that helps you get to your adjusted gross income. Then from your adjusted gross income, you get other deductions, which everyone knows. You can deduct your mortgage interest. You can deduct SALT taxes. That's state and local taxes plus your real estate taxes. Dave's going to get into the itemized deductions. And if you don't meet the itemized deductions, it's the standard deduction that you use. In this case, it's a pretty big number, $577,000. So the question is, what's the true income of these parties that are reporting? Is it 1.7 million that they were taxed on, or is it 2.3 million or 2.5 million? That's a great question. A lot of these adjustments are just for tax purposes. In actuality, their income would be 2,352,000, and that's the way that we would, look at it for income purposes. Okay. This is page 2 of the tax return, and I really just wanted to point your attention to what's highlighted here, which is sort of in the middle of the page. It's under the refund section. So what's happening here is that throughout the tax year, this taxpayer overpaid their taxes by $384,000. So that's a refund of $384,000. This taxpayer elected to have $193,211 actually refunded. That's the IRS writing a check to the taxpayer and going into a bank account. Now you see this adjustment here, amount applied to your 2023 estimated tax. That's the next year. And this is important to pick up on the tax filing that immediately precedes the date of commencement, especially if the parties are going to file separate tax returns going forward. And the reason being is that this $180,000 was parked with the IRS. It could have been distributed. It could have been put into a marital bank account. But these particular taxpayers opted to put $180,000 as a credit toward future tax obligations. And if you're not on top of it and you're not savvy, you could miss out on $180,000 of an asset to the marital estate. And you certainly don't want to have one spouse get the total benefit of the $180,000 and the other spouse get conceivably none of it. So I wanted to point that out specifically.
I'm just going to add a couple of things to that. Excuse me. This is just the federal. There might be a state one as well. So you should always be on the lookout for that. But if you look up at lines 26 and 31, statement 5 will show all the estimated tax payments. Let's say, for instance, these people got divorced in, let's call it December 31st of 2022. Okay, the tax return is usually filed, let's call it April 15th is when it's going to be filed. Okay, of 2023. The line line 31 here shows amount from Schedule 3, line 15. That's going to be a payment with the extension. So that extension payment might have been paid after the actual commencement of the action. So you're gonna wanna look at when that payment was made as well, because it might affect whether the entire estimated tax is marital, or maybe they paid it from separate funds, post commencement. So that's just something else just to keep in mind.
Very good points. The last thing on this page that is just useful to have in your back pocket is the tax the tax return preparer. Their information has to go onto this second page of the tax return. So it's just helpful in terms of discovery and knowing who you're going to in order to retrieve the historical tax returns for the parties for either personal or business or both. So let's move on to Schedule 1.
Okay, I think this is me. So we'll talk about this a little. This is Schedule 1. This is where that $1.9 million number that flowed through to page 1 of the return comes from. Okay, and on this one, it happens to all come from Schedule E, rental real estate royalties partnerships on line 5. It could come from any of the above. We'll talk a little bit about them. Taxable refunds. We don't usually see those anymore because of the new SALT laws, because you're only entitled to take $10,000 of it. So the state tax is usually not, any refund is usually not taxable anymore. Alimony received, we see once in a while, but again, that's going to be prior to the changes in the tax laws. Business income we see all the time, Schedule C. Other gains, Form 4797, that's a flow through from a sale of an investment or something. We might see that sometimes. Number 7, unemployment compensation. Probably not in most of the, we do see it, not that often, because we don't as evaluators, because we're probably not going to be.
We're dealing with the employee.
Yes,
Right.
usually. Line 8, B, gambling, as Lou said, always one of my favorites to point out. You could take losses, again, only up to your wins. You can't have negatives on your tax return. But if you have gambling, if you get lucky, you hit a slot for, or $100,000 and you don't have $100,000 of losses, you're gonna have to claim some kind of income. Cancellation of debt, we see once in a while. Those are really the ones, jury duty pay, every once in a while comes on. Prizes and awarded, you go on a game show. I like to talk about that one. If you, line M, if you won a medal in the Olympics, believe it or not, taxable to you. So the
IRS will get you.
They will find you. And then, then there's some other income in Z, statement 7, which we'll show you later, but it's a small number. We don't have to really worry about that. And then there's other adjustments to that. So educator expenses works for me. My wife works in the school districts. She gets to write off $250. So wow, I save, that's a whole lot of money there sometimes. Health savings account we see, self-employment tax. If you paid your self-employment tax this year, you're your own employee, you get 50% of it back. You have a self-employment SEP or a qualified plan, that goes against it as well. Those are the ones that we normally see.
So just to show you the quick back and forth. So if you remember from page 1, we had right here, other income of $1,974,000, and I'll zoom in on that. And we had adjustments to income of $24,458. So those numbers, just so that you know, they're coming right from this Schedule 1 that Dave just went through. Okay, so now back to page 1. The next adjustment that's made are these itemized deductions. Okay, and that's going to be on Schedule A, which we will go to now. Let's see.
Okay, so medical and dental expenses have to be above 7.5% of your AGI. This guy made a lot of money. This family made a lot of money. So that's a fairly large number. We don't see it as much anymore since they changed the rules on that. Taxes paid, again, real estate taxes, state taxes, only up to $10,000. You can see they had $343,000 and change of taxes, but they only got to deduct $10,000 of it. So pretty big difference. That's kind of why New York now has the PTET. So you can get some, if you have your own business, you can get some credit for it. Because certain states that have really high income taxes, their They're citizens, whatever you want to call us, we were getting killed by that. So they gave us a little break towards that. You get to write off your home mortgage interest only if it's used for your actual home. Okay, you can't do it for repairs and capital improvements, but to purchase your home or a second home. Only the first two, and there's actually limits to the amounts you can take based upon how much the mortgage is. If anyone has any questions on that, you can just email us and we'll get back to you on that. Gifts to charity. Person's very charitable, get $562,000 of gifts to charity. Shows you to go to statement 9. So if we go to statement 9, which we're going to now. Okay, you can see there's a whole list of them, and a lot of them come from K1s because their business gave the charity in their stead, and then it's a pass through on Schedule K1, and it goes to Schedule A in this case, so they can take the deductions on that. Okay, back to itemized deductions. If you go to the very bottom, you have miscellaneous things now. They don't really, there's very few of them that actually come through anymore. We used to be able to write off tax preparers and stuff like that. You can't do that. There's very few, and then there's a total for it. That total, by the way, is also subject to a limit. Okay, so you're going to sometimes lose a percentage based upon your income on that stuff.
Okay, next is Schedule B. So Schedule B, like we were talking about on page 1, those interest and dividend reporting. So this is going to be the detail to it. And there's a lot of information to be taken from Schedule B. So we redacted a lot of the information here, but as you can see, they have to report for the bank account that is being reported for. So they have to put Wells Fargo Bank. Very commonly, and we had to redact it here, this is NFS is National Financial Services. That's Fidelity, right? So they have a Fidelity brokerage account. This redaction was actually an account number. And what this is doing is reporting for each of those accounts the interest income that the taxpayer received during the tax year. This is useful information because at some point we are going to receive a statement of net worth, or for our Connecticut friends, a financial affidavit. And we always want to cross-reference Schedule B with the bank accounts and the brokerage accounts and the savings accounts that are reported on the statement of net worth, and make sure that the statement of net worth is complete. Secondarily, you can see these entries here that say from K1. Okay, so what is that? That means that the businesses that this taxpayer has an interest in received interest income and passed that income along to the shareholder. So I highlighted, I know it's a small amount, 29, but I wanted to point out, let's do this again. So over here, we went through these Schedule K1s last month, right? And we said on Schedule K1, each partner, or in this case, each shareholder is going to report their pro rata share of each bucket of income, okay? So in this case, this particular shareholder, their pro rata share of the interest income was $29. This is a member because it's a Form 1065. Thank you, Dave. So this member reported $29 as interest income from the business. It takes that $29 from the Schedule K1 and it goes right on to the tax payers specific Schedule B, which is what you see here. So that's why we highlighted that. Again, from K1, here we have 1, 2, 3, 4, 5, 6. We have 7 different entities that are being reported just on Schedule B alone of this tax return.
And that's just the interest because there's dividends below that have them as well.
Exactly. So what we're going to do is, once again, go to our net worth statement, go to our financial affidavit, and analyze and do a side-by-side and make sure that every business that the taxpayer is receiving income from in the form of interest, in this case, is reported on that statement of net worth.
And if it's not, when they say it's closed, ask for a final K1.
Yes,
because that'll prove it to you. You can actually, if you go up one, by the way, back to, we were talking about moving things from to the net worth statement. Here's expenses you can cross-reference as well. You can cross-reference things like taxes. You can cross-reference the real estate taxes, you know, the mortgage interest, your contributions, all those things can be cross-referenced back to the expense section of a net worth or a financial affidavit.
exactly. So scrolling down to part 2 of Schedule B. So it's very similar to the interest section, except everything's going to apply to dividends that were received. So in this case, this taxpayer received dividends from NFS, National Financial Services. We get a couple of account numbers out of it, which is useful information. And then also from pass-through income from businesses through Schedule K1, which of course we're going to cross-reference and make sure that every business is being accounted for on the net worth statement, the financial affidavit. Okay. Part 3 of Schedule B, and I want to scroll down without going to the next page. Okay, so this is reporting for any foreign accounts. Okay, so this is actually promulgated by FinCEN. That's the Financial Crimes Enforcement Network, FinCEN. So FinCEN has this form 114, and if you have foreign assets that exceed $10,000, pretty low threshold, you have to check off this box here under 7A, and you have to report to the IRS that you had foreign assets that exceeded $10,000. This is incredibly useful if you have a client who is concerned about foreign assets, okay? And especially with a $10,000 threshold, that's pretty low. Just to bring your attention to a couple of things, within 7A, the description here says at any time during 2022, did you have a financial interest in or signature authority over a financial account? Okay, so there are a lot of times that we'll see the box checked off yes, and that's because the taxpayer, they might not have a bank account personally in another country, but they have signature authority over a bank account for their business that does business overseas. And because of that, they may have a Canadian bank account, you know, some European bank account, in which case this would also be checked off yes. Now, FinCEN Form 114, there's no requirement for that to be attached to a Form 1040. So you want to look through the Form 1040, see if it is attached, and if it's not, request it. It's a new discovery demand. Now, within the IRS's guidelines, there are reporting requirements for foreign assets. That is on Form 8938. Now, Form 8938 has less stringent requirements for reporting foreign assets. You only have to fill out Form 8938 if you end the tax year with $100,000 or more of foreign assets, or if at any point during the tax year, those foreign assets were $150,000 or more. So you have someone out there with $75,000 in a bank account in England, and they don't have to do Form 8938, but they do have to do FinCEN Form 114. So just to scroll down this a little bit, so right on the first page of Form 8938, so this is going to be a summary, part 3. That's a summary of all the assets. It's they call them deposit custodial accounts, the bank accounts. Other foreign assets, all right, those are going to be you know, your business interests and your real estate. This is a summary. On the next page, part 5 is where you have to actually detail out account numbers, institutions, even the country which those bank accounts are held within. So that's part 5, and part 6 is going to be for any other assets, like we just said, business interest, real property, like real estate, things of that nature. So it's just a very useful piece of information when you have a client with concerns of foreign assets.
Hey, Lou, we have a question.
Let's hear it.
Are foreign assets just money in a bank account? What about real estate?
I think I just sort of answered that. Yes, it is both bank accounts, it is real estate, it is any real property. You can own a car. You could have a Lamborghini in Paris, and that's a foreign asset if it's registered there. And includes real estate as well.
And by the way, if anyone does have a Lamborghini in Paris, I'm going there next week, so if you could give me the keys, I would greatly appreciate it. Thank you, Lou. Good segue.
So happy I teed that up for you.
All
Okay.
right, we're gonna move on to Schedule D, capital gains and losses. So this is, sales of assets. You have Apple stock, you have any other stock, and you sold it during the year. You have to report any gains or losses on Form Schedule D. So you have your short-term gains, okay? Box A means it's been, the form has been sent to the proper government authorities. B and C means it hasn't been sent to the proper authorities, okay? The majority of what we see is A. Now, is in box 1B, so box A, checked. So you can see here it's $2.6 million, okay? The rules are now that you actually have to attach a second form if you don't report them individually. So you can report them because a lot of people may have, 75, 100, 150 different transactions that make up that 2.6 million, okay? If you have that many and you don't list them out separately on the forms that are attached to the personal tax return, you have to actually send them into the government.
The forms themselves.
Correct, the forms with a cover sheet form, okay? So, so you don't usually see that on the tax return, just be aware of it. If you get the copy of the 1099, you don't have to worry about that because that's where all that information is coming from. You can see, number 5, short-term gains losses from partnerships, S corps, trusts, see statement 15. Those are things that may or may not be coming from the business that we talked about. I believe the one with the K1 that we have does not have any,
Right.
but there are other businesses that do have. And then line 7 is just the total of the short-term capital gains and losses here. You can see they have a loss of 110,000 and change of short-term. So now we do the same thing with the long-term. Okay, you have 8A, which is all the long-term transactions. And then you have B, 9, and 10, which D, E, and F is the same kind of concept of as above, what was and what wasn't sent to the government. Then we have Form 4797 here, Statement 14. We're going to attach a second form. We have that in here? I believe we do.
Yes.
So we'll show you that in a minute, but you can see it's $335,000 in change. And then you have losses from K1s of another $770,000, which means you have a net long-term capital gain when you add all these up to a loss of $559,000. So if we go to page 2, we now have $669,000 in change of losses.
And just so that you see where the 669 came from, it's the 110,000 of short term plus the $559,000 of long term.
Okay. So what happens to that $669,000? Well, as we discussed earlier, you can take a whopping $3,000 of that against your income and save money. Okay, that'll show on statement 17. Now you have 666,000. Yes, it's the devil's number and change left. Okay, of gains, of losses. This is now going to be a carry forward into the future. So it's something that you should be aware of as an attorney, that may be an asset of the party. That it is an asset of the parties if they're married, married, filing, joint. Okay, and there's rules to who can take those. If you have questions on that, you can email us. That I don't want to go too deep into it because we'll be here forever. But fairly simply, it's the person whose name is on the account gets to take them, or in this case, the business would get to take them as well.
Right. The capital gains or the capital loss carry forward attaches to whoever owns that particular asset. So if it's a particular brokerage account, whoever has custodianship of that particular brokerage account is going to be able to take that loss forward. You won't be able to transfer it to another spouse. So you'll have to come up with it in another way. The reason why it's an asset is because these losses are going to give rise to some tax savings down the road. They could have $500,000 of income in the very next year, and they won't have to pay tax on any of it because they have $666,000 of loss carried forward. So the asset is really the tax savings, and we do calculations and analyses on that. If you ever need any help with that.
Correct. So this is Form 8949. We told you that we'd have, we'd show you where this stuff comes from. So NFS, we talked about date acquired, date sold it on the last day of the year, had a loss of $96,000. There's an adjustment here. W is probably a wash sale. So they purchased the same stock
Within 30
within
days.
30 days at a higher price.
Right. If you sell it at a loss and
Right.
then you buy it back within 30 days, you don't get to write off that loss. That's what that adjustment is.
Correct. Okay, and moving on, we have another Form 8949. This is short term, but this is a foreign currency exchange. So, they exchanged some foreign currency. They lost $93 on that. Then we have some Coinbase stuff. Lou, you can take it. That's more you love this stuff.
I do. So in 2014, the IRS started to see the rise of Bitcoin and cryptocurrency, and the IRS says, well, we're going to make this stuff taxable. And the way that we're going to do it is we're going to put it under the definition of quote unquote property within the Internal Revenue Code. And property, as we know, as we've been discussing, property could be real estate. Property could be your stock, such as Apple stock, Amazon stock, and now cryptocurrency and digital assets like NFTs. They fall under the categorization of property. And property under the Internal Revenue Code is to be reported, or at least the gains and the sales and the gains are supposed to be reported on Schedule D, and more specifically, this Form 8949. So in this particular case, they actually did two. We have Coinbase short-term and we have Coinbase long-term. And this is just good to know because, we saw box one of, we saw page one where they disclosed that cryptocurrency was sold and or exchanged digital assets. Right. So now we know that there's a Coinbase account in play. So this is certainly something that, once again, we're going to go over to our net worth statement and we're going to take a look and see if there's any disclosure of a Coinbase account, and not just Coinbase, but any other digital asset wallets and those wallet IDs, which are so important in doing the tracing. If you joined us a few months ago when we did that. So, always good to know, some high level information. We're looking at 8949. We're just breezing through the tax return. And we know that this taxpayer is utilizing Coinbase, and it's a good starting place for any crypto tracing.
Okay, Schedule E. There's 2 pages to Schedule E. The first page is your royalties and your rent. So this one has, you can see box A is a royalty, and then B is a property. They'll tell you the address in B. We obviously, for purposes, didn't, leave that on. It'll also tell you how many days it's rented for and what type of property. In this case, it's a single family residence. So it just basically gives you the rent received. Obviously, this is something, if there is, you want to go back to your net worth or your financial affidavit and make sure that it's disclosed, okay? But it gives you, they rented it for $10,000. They had, some expenses against it, insurance, utilities, a whole lot of depreciation. So now they get a loss against it of $73,000 in change. You got to take the 94 against it, which is the income they have from royalties. And now you have total rental and real estate from age one of a loss of $73,410. So now we look at page 2, and page 2 is your businesses. And as we know, we've talked about, there's numerous businesses that these parties had. So you can see if you go to here, GHI tells you this passive loss. You got to go to Form 85 82. We did not include that passive income and passive loss. Those are very technical. If you have questions on it, you can contact us, but we didn't want to get too much into the passive activities. There's passive income, there's non-passive loss, and then there's non-passive income, and overall, it adds up to over $2 million of income, which you can see on line 32. Okay,
So I'm just gonna skip ahead to statement 18. So when you open up Schedule E and you see a reference to statement 18, what that means is that the taxpayer had more than 4 businesses. This only gives you room for 4. So I'll go over to statement 18 and we'll get a little bit more of the detail here.
okay, and you can see there's numerous different entities, okay? And we highlighted the passive income of 32,749 because if you go back to the K1 from the business, that's the exact amount. You can see it on line 1 now on the K1 32,749, and it goes directly to Schedule E. So we want to kind of show you guys how these different things work. Okay, so that's the income, the ordinary business income that they made from this particular business that flows through to Schedule E on their personal tax return.
Right. Can I walk them through the first page of the tax return?
You can do as you like, young
Perfect.
man.
Okay. So if you look at this particular business here, this business reported $296,277,000 of pass-through income, okay? Or rather income that is going to be passed through to the partners. Now, that's why it's so important that we verify the revenue of the business, which is the $30 million in the beginning, and all of the expenses that go against it, the $7 million of cost of goods sold, the $23 million of operating expenses, if you will. All of that results in the $296,000 of business income, as we spoke about last month. That $296,000 is going to translate to this particular shareholder. So this shareholder owns 37.5% of this business. So they are going to report 37.5% of the $296,000. That math, take our word for it, is $111,104, which goes directly back to our Schedule E and is reported as non-passive income. So you can sort of see the steps from the revenue of the company down to the expenses of the company, down to the income of the company, to the Schedule K1 of the shareholder, to the personal tax return of the shareholder.
And of course, that does not include if they took a salary, because that would be on page 1.
Exactly.
The W-2.
Exactly. And what's really useful, I think, in New York specifically, we're always interested in the non-passive versus the passive, because that'll dictate if we're looking at it as of the date of commencement or as of a current date, et cetera, et cetera. The Form 1040 Schedule E, it tells you if this is non-passive income or passive income. So the $111,000 is coming from a non-passive asset. So the taxpayer is working within that business versus the 32,000 where it's passive income and they may not be working in the business, and maybe it's just an investment holding company, something to that effect. Going back to Schedule E. Page 2.
All right, so you can see this 2,047,000. They'll add that then to what was on page 1, which was the minus 73. So that'll come to the 1,974,420, and that'll go back to page 1. Technically goes to Schedule 1 and then to page 1.
Exactly.
But so that's how it all flows through. Okay. Now we have Form 1116. We're going to go through this quickly. This is foreign tax credits. I'm sure a lot of you know, if you make an investment, in a company that pays foreign dividends, they may have to pay foreign tax on it. You get, because you've already paid the tax on it, you get some type of credit for that. Okay, so it figures out based on the income, all their percentages, make sure that they don't overpay too much on the taxes, so you don't get some wacky, and the US doesn't lose out on their money. But at the end of the day, you can have multiple Form 1116s, okay? And one is, might be just for regular income tax, and one might be for alternative minimum tax. Or there may be, more than 3 different things, foreign countries or US possessions that they get it from. So at the end of the day, you can take this as a direct credit, or you can take it on your Schedule A as a deduction. Most people take credit because it's a dollar for dollar credit. Okay, as I talked about on the itemized, first of all, you have to be above the standard deduction anyway, but also you may lose a small percentage of it. So, it pays, most people take it as a credit for that reason. So there's really nothing much more to go through on that form. These are all the schedules that we saw, going through them quickly. The wages received, goes back to page 1. That comes from the corporate tax return or the partnership tax return that we talked about. Qualified dividends we talked about, that breaks it down between ordinary and qualified. We'll explain the different percentages. If you have questions on any of this stuff, guys, we're always available for you. It has 3, the qualified dividends and capital gain worksheet. The tax on it, federal income tax withheld from the W-2. Then you have a 4th quarter estimate that was paid. So when I talked about, let's say they got divorced in October 1st or something, that would be the very beginning of the 4th quarter. This is probably made after that, because 4th quarter estimates are usually made December 31st, January 15th, something like that. So that's another thing to just be on the lookout and be aware of on the tax return that you can figure out. Other income withheld from Form 8959. That's, just another, the forms we've gone through. Some miscellaneous income. Here's the state and local taxes that were paid during this year. This will flow through to Schedule A. It tells you right there on the left, actually, Schedule A. And basically, these things tell you all of them tell you where they flow to. The one with the miscellaneous income, Schedule 1. This one, Schedule A, above it, Form 1040. Here, investment income goes back to Schedule A. That was at the very bottom. Real estate taxes, you're right back into the tax section of Schedule A. Breaks it down. There's, the taxpayer and joint. That's how they paid it. Sometimes it'll even tell you, like if you pay it through your mortgage, Chase, it'll say that. So
Sometimes it'll say the address of the property as well.
correct. So you want to be on the lookout to make sure that you have all those accounted for. Then you have everything that goes to Schedule D, long-term capital gains and losses, your forms, 4797, 6781 was negative $1, but still there. Then your short-term capital gains for partnerships, it says, again, goes to Schedule D. And then we have capital loss carry forward. We kind of talked about that. Let's look at this, I guess, a little further. So you have $1.7 million, you had a loss of 3. This is just I guess this is the short term. No, sorry, this is the long term. Short term is above it. So the short term is 107, long term is 559. That's the total. Came to 666, like we talked about.
This is presenting a breakout of the
Right.
total carry forward, whether or not it's short term or long term.
Right, and at the end of the day, it technically does not matter, but because you could take your carry forwards against either one.
Yeah.
But it breaks it down. I really don't know why, but it does do it for you. And then we have, this was the Schedule E, your statement 18. I think that's probably just about the end. And then non-farm income, this is just for SE purposes. Really, nobody knows why they show gross non-farm income.
Yeah,
It's not used. It's just not something you really have to worry about.
and
that's kind of it.
And that is the entirety of
The tax program.
presentation.
Are there any questions, Sammy?
Yes, we have one more. It was from
Excellent.
a bit ago. I just, does the capital loss factor in when valuing a business?
So are we talking about the actual loss or the carry forward? So it depends what kind of business it is, first of all, right? If you're valuing a business that's like I guess if it's a private equity or a hedge fund, yeah, go into it, because that's gonna go into the actual value of it.
Yeah. Items like that should already be factored into, the person's capital account
Right.
balance when you're looking at it at the end of the year. So yes, using a private equity firm or a hedge fund as an example, a capital loss is certainly going to affect the value because it will lower that person's capital account. It will already be considered in that capital account. So yes, it does affect it. It's usually already considered, already included in the reporting of that particular business.
Right, but let's say you own a warehouse, like a retail business,
Mhm.
and you happen to have a brokerage account, and there's a loss that you have for that year. That is not gonna be factored in the valuation, but the value of the account will be.
Yes.
Just not the fact that they lost money as a capital loss. That will not be factored in the value, but because I assume the account would have gone down in value because of that, the value of the account would have been affected by that,
Right.
and that would go to the business value.
Yep, exactly.
Any other questions?
Nope, that was it.
All right, so we're gonna revisit a little of the NCAA tournament predictions I made. You can lose rolling his eyes as usual, but I gave you 3 of them. I think the first one was the play-in games, which I was totally wrong on. None of the play-in teams moved on to the next round, so I blew that one. Did give you Michigan State, be on the lookout for them. They made the Elite Eight. They lost by 6 to one of the best teams in the country. As I said, never doubt Izzo, drives me crazy. And I gave you also the 12s over the 5s. And that was my hit because there were 2 12s over 5s and almost the third one. I'm very happy the third one didn't happen because it was Michigan, and that's my team. But so 2 of them did come. So 50%, that's a pretty good analysis on that one, I think.
Very proud of you. Not my wheelhouse. I have
Thank
nothing
you.
else to add.
Lou wants to talk about the Jets draft instead, but I think we can pass on that.
I think we could pass. I'm good.
Yes. So
All
we thank you for joining us.
Yes.
If you have any questions specifically, you can always email either Lou, myself, or Sammy, and we'll get back to you in short order.
When you leave this presentation, a questionnaire should pop up for you. What we are really most interested in is if you could fill out topics that you're interested in for us to present on in the future. We want to make these things as interesting and informative for everyone as possible. So, if you can at least fill out that part, we can certainly, get a good laundry list of topics that we know that at least you guys want to hear. So, thank you for joining us. Thank you for listening in and sticking with us for the full hour. I hope everyone has a great day.
Have a good one, everyone. Take care.